People have joined. So again, welcome. My name is Erin Higgins. I'm the operations manager at OHFA. Everything, when you guys submit files in, when you make reservations, all of that comes through the home ownership department. And again, I'm the operations manager in the home ownership department, so we take care of, tracking the reservations, trying to keep the pipeline up to date. We review files as they come in. We pretty much do it all. Everything that you'd have to do with OHFA, you're going to do through the home ownership department. So just a little bit of background on me. I've been at OHFA for a little over 2 years as the operations manager, and prior to that, I was in the mortgage business just like you are. I have originated, I've processed, I've closed, I've underwritten, all of that. So I know where you're coming from. I've used OHFA throughout my entire time, my entire 30-year career in the mortgage business. So, there were some things that I knew I wanted to change when I got this position, things that I thought, we could be a little bit more user-friendly towards the lenders. And so we have made some changes over the last couple of years. We're still working on things to change and improve. But hopefully you will find that the program is a lot more user-friendly, that you're getting good customer service. That's important to us. We know that we need to, we want you to be able to trust that when you send us a loan, it's going to get done and you're going to be able to close your deal. So basically today, we're going to talk about products and what we have to offer. We also have a webinar scheduled for anyone who'd be interested tomorrow from 10 to 11:30, and that would be basically pretty much for ops staff. We're going to look at Lender Online and how you reserve things and how you work around in Lender Online, submitting to us, what to expect, that kind of thing. And then on Friday, we have a webinar scheduled from 9:30 to 10:30 with U.S. Bank. If anybody from post-closing would be interested in that, they'll talk about how you submit things to them, what the expectations are, what they're seeing a lot of, as far as deficiencies and things like that. So you are welcome to join us. If you need any of that information, just shoot me an email after the call, and I will send you that. It was on the same reservation or the same memo that we sent out for this call. Okay, so let's go ahead and get started. Just some basic things. We're going to start with there. Our mission is to open the doors to an affordable place to call home. We do this by offering competitive rates, down payment assistance, and hopefully excellent customer service. All of our loans are currently serviced by U.S. Bank. You can reserve a loan which locks it in, which locks the rate from 9:45 in the morning to 8 o'clock at night, Eastern Standard Time, Monday through Friday, excluding holidays. Once the loan is reserved, any product changes must be approved by us. We ask to receive commitment packages within 25 days of reservation. You'll find that we don't ask for a lot. We ask for pay stubs, we ask for tax returns, we ask for a copy of the contract, a 1003, and a transmittal, basically, unless you're using like a HEROES program or Grants for Grads, we may ask for a little bit more. But we're hoping that you have that information within 25 days. We're hedging these loans out on the market, so we want to make sure that we're not just keeping a loan ahead. We're not rolling a hedge for no reason. That we have a good loan, we have one that you believe is going to close. So that's why we ask for them to be within 25 days. And we do reach out to you, so you will hear from us if we don't get the file. Loans must be purchased by U.S. Bank within 70 days of reservation to avoid any extension fees. So it's not that it needs to be closed in 70 days. It needs to be closed and purchased by U.S. Bank in that time frame. So the definition of a first-time home buyer, I just want to be clear about what this is. All the years that I worked with OHFA, I never really knew the true definition. I always thought you could not have owned a home before, and that's not really the case. The definition of a first-time home buyer is a person who has not had ownership interest in their primary residence in the last 3 years. So we often have borrowers who maybe they're still on title to a property that they had with their ex-spouse for some reason. But if they haven't lived in that property for 3 years, then they could be considered a first-time home buyer. Maybe there are people out there who rent the home that they live in but also own rental property. they would be considered a first-time home buyer if they haven't owned their primary residence in the last 3 years. A person buying in a target area is considered a first-time home buyer. And there is an exception, a one-time exception for qualified military veterans who have received an honorable discharge are eligible as a first-time home buyer, even if they have previous ownership in a primary residence in the last 3 years. So that kind of brings us to just a note, if the borrower does have other property, whether it is a primary residence they currently own and are going to rent out, or they just have rental property, then we are going to we're going to use gross rental income just to make sure that that borrower doesn't exceed our maximum income limits. We have income limits for all of our loans, depending on the county that they live in. There are income and purchase price limits. It's based on the county. It's also based on how many people are in their, how big their household is. Sorry, I'm going to turn this phone off so it doesn't beep. And then, so they have to meet the gross rental income. So if they do have rental property, then we're going to make sure that the rental income that they receive or could receive does not exceed our income guidelines. So if they're purchasing a 2 to 4 family, we'd also count the rental income, or they intend to rent out their current residence, then we would take 75% of the gross rental income. If they currently own rental property, we would take 75% of the net rental income that they show on their tax returns. Why we have that calculation, I can't tell you. That's one of those things that I just kind of inherited when I got here, and we are going to be kind of looking into in the future how we look at some income things, because they're a little differently than you look at them as a lender. And we just need to delve into why we look at it that way, but we will be looking at it. We will be taking a look at that. But for now, that's how we look at it. If they are going to have other property, or they intend to keep their current primary residence, I should say, if they have owned it in the last had ownership interest in their primary residence in the last 3 years, they either need to be buying in a target area or use our Next Home product, which we will get into. Okay, so now that I've stumbled through that, let's move on. How are lenders notified of new rates? We have, when a lender signs up with us, we ask them who they want their main contact to be. And that main contact gets a blast from us every day, an email from us every day with our rates. As lenders participate in our program, they tend to build that list up so more and more people are getting the rate sheets. But they are also posted on Lender Online every day. They'll be on Lender Online before they come out to you. And we can possibly have midday rate changes. We have had them in the past, and we will give you as much notice as we can if that happens. But Lender Online will always be the final source for current rates. They are posted on our main website too, so you can find them there. This is what our rate sheet looks like. You will get this every day. It'll show you, that it's the rate lock is for 70 days to get it purchased. It tells you when it needs to be purchased by. You can see that it's broken down by government and by conventional. And then it's further broken down by just our regular first-time home buyer and Next Home, by our Ohio Heroes and Next Home, and grants for grads. And then you can see that it's broken down by whether they want assistance, no assistance, or whether they want 2.5% down payment assistance or 5% down payment assistance. And here's just a little bit closer up version, so you can see how it's tiered and you can see the different categories. It's pretty basic, though. I'm sure for the rate sheets that you guys read, it's pretty simple. So given, again, I wanted to stress that we would like those reservation those commitment packages within 25 days of reservations. Our docs do not need to be signed by the borrower prior to submission. So you'll note that I said that we asked for, tax returns, pay stubs, a contract, and just your basic 1003, 1008 FHA transmittal, whatever it is we want a transmittal. because we are now preparing the documents. If you've ever used our program before, you know there was what we called a commitment package, which was kind of all the major docs that the borrower signed at closing that said this is what our purchase price is, this is how much money I make, all that stuff. We found a couple years ago that there was so much back and forth between the lender and us, and here's what it says, and here's, this is what it should say, and all that we decided that it would be a whole lot easier if we just collected the information ourselves and we made those documents. So that's what we're doing. So nothing needs to be signed by the borrower until it gets to closing. We will prepare most of the documents, which we call the commitment package, for the borrower to sign at closing, and you as the lender are responsible to prepare the closing documents. We are throwing around an idea, hopefully going to be able to at some point prepare those closing documents for you, so it would make it even easier. We're just not there right now. We're so busy. We have so much business, which is great, that we're just kind of, as all of you are, we're very busy, and it's just things are kind of being put on the back burner. But that's one of the goals that we have, is to be able to, at some point, do that closing package for you and make the whole process even easier. So again, within 70 days of loan reservation, the loan must be purchased by U.S. Bank. So we recommend that within 3 to 5 days of closing, the package gets submitted. There's a package that goes to OHFA, and then there's a package that goes to U.S. Bank. And given the time frames, you just want to keep in mind that that things that are going to take longer to close, like maybe it's new construction, or it's a foreclosure or a short sale, that if it's going to take longer to close that loan, you probably want to wait a little while to reserve it. Maybe not reserve it at the time of application because of that 70-day time frame that you've got to get it closed. So just a suggestion. Some lenders, have it down that they reserve it maybe after they receive the appraisal or something like that. It's probably not a great idea to wait, especially as busy as we are, to wait until that loan's been all the way through underwriting, because pretty much when you get it through underwriting, you're ready to close it. And right now, it's taken us a while to do an initial review of the files, because we receive probably 400 loans a day that we need to review. So it's taking us some time to get through that initial review process. So the sooner you can submit it to us, the better. If a reservation period expires and the loan's not closed, no new reservation can be made for the same borrower purchasing the same property until 60 days after the expiration of the prior reservation period. And basically, we're just trying to avoid having duplicate applications for the same borrower, avoiding the loans being canceled so they can get a lower rate, and all that stuff that you don't want done in your pipeline. So that we have made exceptions to that in the past, so I certainly do encourage you to contact us if you have a situation. But that's just our basic guideline right there, our basic rule. In the event that for some reason the first mortgage doesn't get purchased by U.S. Bank, and normally that has something to do with TRID or some compliance issue, then we will, as part of our contract with you as the lender, that we will purchase that second mortgage for you, from you for a fee. And that way it's just not something else you have to worry about. You don't have to worry about the fact that you've now funded the borrower's down payment. So we just offer that as a convenience for you. So if you need more time than the 70 days, and it does happen, there will automatically be an extension fee of 3/8% of the original loan amount when the loan closes. If it goes over that 70 days, U.S. Bank deducts that, nets that out of the purchase on behalf of OHFA. That is an OHFA charge. That's not a U.S. Bank charge. They just net that out on our behalf. We do not allow that extension fee to be charged to the buyer or the seller unless the buyer or the seller is the reason for the delay. And if that's the case, then please send me an email, let me know what's going on. I have no problem if you can show me how they have caused the delay in allowing you to charge it to the borrower. or the seller, whoever was the cause of the delay. But if it's not something that's been pre-approved before closing, then we will request that you return that to the borrower when we'll review the closing package. Okay, so TRID, the dreaded TRID. When we went, just to give you a little background, when TRID came out, we had a lot of conversations, a lot of calls, a lot of everything, trying to figure out how our second mortgage fell into TRID. It's kind of unique in that we don't have a payment on it. It's a forgivable loan. There's no finance charges or anything like that. So through numerous calls and webinars and all that, and a couple of calls that we had directly with CFPB, was determined that we don't meet TILA. There's no finance charges, so we do not have to provide a TIL. There is something that's called a partial exemption. I don't know how much any of you got into the whole TRID thing, but there is something that's called a partial exemption. I still am not clear on what exactly that documentation would be, but our loans don't meet the partial exemption. There's maybe 6 or 7 criteria, and one of the criteria was that your total fees, including your recording fee, cannot exceed 1% of the loan amount. And when you have loan amounts that are 2.5% or 5% of the purchase price, and you have a recording fee, it's typically, the recording fee is typically going to be higher than 1% of that loan amount. So we didn't qualify for the partial exemption. So now we have to fall back on RESPO. What does RESPO require? So we have to go back to the old days of not quite a year ago, and we are required to have a GFE and a HUD-1 settlement statement for the second mortgage. So in our calls with CFPB, we knew that lenders weren't going to be able to have a GFE. We made the assumption, and you know what happens when you assume, that title companies would still have access to a HUD-1, and pretty much every document you ever need is available on HUD.gov, but we knew lenders wouldn't be able to generate a GFE once TRID came out. So we talked to them and we asked them if it would be possible, because we thought that we had an argument for us sending the GFE. We are the lender on the note and on the mortgage. OHFA is listed as the lender on both. So we made the argument that it should be within 3 business days of this loan being reserved with us. Since we're the lender on both of those, we should be able to generate a GFE. And we were very clear that that is not likely to be within 3 days of the borrower making application with you as the lender, but it would be within 3 days of us making application with us. And they agreed that since we are the lender on the note and the mortgage, that's possible. That we So we do generate a GFE on any loan that is assisted within 3 business days of application. We typically get them done the next day, but sometimes we have a lot, so it does take 2 or 3 days, but they will all be done within 3 business days of application. We will mail them to the borrower, who is the lender. Do not need to, and please do not do any kind of disclosure on the second mortgage. And we will upload it to Lender Online so it's available to you, so you can see it. It will be a recording fee only. It will show $52, and how we arrived at $52 was it's $28 to record the first 2 payments, the first 2 documents in Ohio, and it's $8 a page thereafter. There's no writers, there's no anything that go with the second mortgage, so we just said, okay, if you happen to have a long legal description that's 3 pages long, it would be $52 for the whole recording fee. So we kind of tried to overshoot the amount. Generally, we see them at about $36, not $52, but we will disclose $52 to the borrower for a recording fee. Then you as the lender are responsible to prepare a HUD-1 settlement statement for closing that shows the recording fee only. If there are any other fees on that HUD-1, then we get into having finance charges, and that requires a TIL. And I don't have the ability to do a TIL, and I'm pretty sure you don't have the ability to do a TIL. So we're just not going there. We're just going to show a recording fee, and that's it. So, and And somebody says, somebody just asked a question, does the borrower need to sign and return the GFE to you or to us? No, the borrower does not need to sign it. There's not a signature page on the GFE. We keep record of when we send it to the borrower, but it does not need to be signed and returned to us. It just needs to be mailed, and we keep evidence that it's been mailed to the borrower. Okay. If you have questions on that, just ask them at the end, and you may, but hopefully I explained it well enough that you don't. Okay, so what are our programs? What programs do we have to offer? We have, as I said, we have unassisted loans, and we do see in our Ohio Heroes program, which we'll get into in a minute, that is the lowest rate that we offer. So we do see those loans unassisted a lot because it's a pretty good rate. But we offer second mortgages, excuse me, and our down payment assistance in the form of a forgivable second mortgage. So we have what we just call our down payment assistance second, and we have our grants for grad second. Let me explain the difference in those two. We decided September 1 of 2015, we changed the product to just, you can either get 2.5 or you can get 5% down payment assistance. So we called it Your Choice, because it's your choice. You can do whatever, you can do whichever one you want. So the second mortgage amounts are, as I said, 2.5% or 5%. You can use it for whatever you want. I don't care what you use it for. You can use it for down payment. You can use it for closing costs. You can use it for prepaid. You can use it to pay a borrower single premium. You can use it for whatever you want. The lien is forgiven and released after 7 years. If the home is sold or the first mortgage is refinanced prior to the 7-year anniversary, the loan must be repaid in its entirety, and we will not resubordinate it if the first mortgage is refinanced. It's not the same. The Grants for Grads has a different repayment than any other loan that we offer. And the reason we did labor over this a little bit because it is the 7 years, but it's the way that the rate is structured and the financing of the rate is structured. In order to give the rates that we do, that's where we came up with the 7-year point. And then our Grants for Grads is the other second mortgage that we offer. It's for borrowers who have graduated from an accredited college within 48 months of the loan reservation date with an associate's degree or higher. We do ask for evidence of the graduation and the date. Excuse me. Our rates for the Grants for Grads are lower than our traditional first-time homebuyer rates, and the second mortgage is forgivable at 20% a year for 5 years. If the borrower sells the home and provides proof that they're going to continue to remain in Ohio, if they would sell their home in less than 5 years and they are going to continue to reside in Ohio, then they can provide us evidence of that and we will forgive the remaining balance. We will also subordinate these liens if they refinance their first mortgage. So truly, in my opinion, this is the best. The Grants for Grads is the best that we have to offer because it has the better repayment. The Ohio Heroes, which we'll talk about in a minute, has the lowest rate. But for me, if I had to choose between the two, and a lot of times we do have borrowers who qualify for both Heroes and Grants for Grads, if I had to choose between the two, I'd take the Grants for Grads just because of the repayment. But that is, it's a really good program. Okay, so our HFA Preferred is the other program that we have that is a great, very underutilized program. Something you might want to check out. It's Fannie Mae's product. It is loosely based on, I should say, their Home Ready program. But it has a lot of enhancements on it to make it HFA Preferred. So you can go up to 97% loan to value with an approved eligible through Fannie DU. There are no loan level price adjustments for being at 97%. There's no price adjustments for the credit score. There's no price adjustments for the type of property, for anything. It is what you see on the rate sheet. Mortgage insurance is at charter minimum rates. Our term sheet shows you the detail, but for example, at 97% loan to value, you're at 18% coverage. So it's the MI is really good on it. It can be combined with our down payment assistance for a CLTV up to 102%. 1 unit single family properties, only if when you go over 95, you can only do 1 unit single property, 1 unit single family properties, and no condos over 95. The only kind of caveat to the Fannie Mae product is Fannie does not allow the borrower to own any other property at the time of closing. So where we talked about before that they were going to continue to keep their primary residence or they owned other rental property, Fannie doesn't allow that. They can't own any other property at the time of closing. But it's a great program. And Fannie did a study that showed they took, I don't even know, like 50,000, some huge number of loans that they that were FHA, that they kind of changed the details on it a little bit to be able to run through DU as if it was a conventional loan. And I think somewhere in the vicinity of 84% of those could have gone Fannie Mae that went FHA, could have gone Fannie Mae at the 97% through the HFA product that could have been FHA. So it's seriously something you might want to look at as opposed to an FHA loan. Our Ohio Heroes, you heard me mention that before. The eligible heroes are active military and veterans, firefighters, EMTs, paramedics, healthcare workers, police officers, teachers. This is a very popular product of ours. The rates are the lowest that we have to offer. They're lower than the grants for grads. They're lower than just our regular traditional first-time home buyers. We do refer you to the term sheet because every occupation has a little different nuance with it as far as how many hours and what certifications and licensing and things like that that we need. Our healthcare workers, I can tell you right now, is the one that we struggle with the most because right now it has the most ambiguous definition. So we are working on and hope to have out in the next couple months a clarification on what those occupations are and the requirements of those. But right now, the definition is basically anybody who is has direct patient care, which is the part that everybody struggles with, is full-time and licensed. So if you have any questions about whether you have a healthcare worker that would qualify, then you can just shoot me. Our Next Home program, I've talked a lot about that already in this webinar. We have a Next Home program for somebody who doesn't fit into that first-time homebuyer category, and maybe they don't have it, they're buying their next home and they don't have the equity in that property to be able to move on and put a down payment down. So this is just for anybody who doesn't fall into that first-time homebuyer category. So they are not required to be a first-time homebuyer. They can have ownership interest in a primary residence in the last 3 years. It follows the same guidelines, the same income, the same purchase price, the same guidelines. Only thing that's not available on the Next Home program is the grants for grads and our MTC Plus program, which we're going to talk about here in a minute. And the reason those are not available is because those two are strictly first-time homebuyer products. Anything else you can use Next Home if they don't fall into that first-time homebuyer definition. And then the Next Home loans are only available with down payment assistance, as are the grants for grads. I don't know that I said that when we were talking about grants for grads, but grants for grads is only available with down payment assistance. They're not available unassisted. Our MTC Plus, our MTC program is also known as, you've probably heard of, a mortgage credit certificate. It's the same thing. We just decided a couple years ago that borrowers really don't understand what a mortgage credit certificate is, but everybody kind of gets the idea of a mortgage tax credit. So the official name of it by the IRS is a mortgage credit certificate, but we just decided we're going to call it a mortgage tax credit, and it's something that people might more easily understand. And how the mortgage tax credit works is we have two programs. We have what we call the MTC Basic, which OHFA has always offered, and now we have the MTC Plus. So just a little background on that. The MTC Basic is a program that you as the lender can offer to a first-time home buyer using your own products. So you don't have to have an OHFA first and second mortgage in order to use it. The Basic is just using your own product. So say you have somebody who qualifies as a first-time home buyer, and maybe they're doing a conventional loan, they want to put 50% down, and it just doesn't make any sense to use our first and second, or whatever your reasoning is. You can always, as long as they meet the criteria for the first-time home buyer, you can use this Basic product. And it offers a 20% tax credit if the borrower is buying in a non-targeted area, 25% if they're buying in a target area, and 30% if they're buying an REO. Excuse me. The income limits are lower for the MTC than they are for any product that doesn't have MTC attached to it, and the reason is that the IRS sets those income limits. And the IRS also, when we were in the bond market, which we're not too much in anymore, we're starting to get back into it, but when we were doing strictly bonds and not TBAs, that too was an IRS product. A tax-exempt bond is an IRS product, as is this mortgage credit certificate. So the IRS never has allowed you to layer their programs. You can do one or you can do the other. Well, now that we kind of got out of the bond market for a little while, and we moved into the TBA market, we could then start layering them with our product, which is where the MTC Plus comes in. And the plus is you can use our first mortgage, our first and or second mortgage. You can do it assisted or unassisted, and you can layer the MTC on top of it to give the borrower a tax credit of up to 40%. And that's the MTC Plus. The plus is that you get to use all of our products. You get to layer it with all of our products. And it's really gaining a lot of popularity. And I think the reason that it is because it's very simple to do. And I'm going to show you, I'm going to go through just a basic tax return this is something that I borrowed from our friends at Colorado Housing. They put this together and were kind enough to share it. It's just a very basic, kind of walks you through the difference between, to a first-time home buyer, between having the mortgage tax credit and not having it. And I think this is very helpful in just showing you how simple it is. So this example on these tax returns, I know they're kind of small, and I will send out this presentation to everybody that's on the call after the call. This example assumes a 30-year, fully amortizing $160,000 mortgage at a 5% interest rate, and it's a 20% tax credit. So you can see on the tax returns, the blue indicates the borrower who has the tax credit, and the black indicates somebody who does not. So on the this borrower just made $50,000. They're filing a 1040. Most borrowers with mortgage interest will itemize. So this borrower is itemizing, although they don't have to. So this basic $50,000 income. And when you get over to page 2, you notice on the itemized deductions that the blue, the person with a mortgage tax credit, has itemized deductions of $97.72, as opposed to the person who does not have the mortgage tax credit, and it's $11,361. And let me take you over to the Schedule A to show you where the difference comes in. So how the tax credit works is it is a direct credit based on the amount of mortgage interest the borrower paid that year. So you can see on line 10 that the borrower paid $7,946 in mortgage interest that year. So how it works is you then go over to, they prepare this form 8396 to determine how much of that interest can be used as a credit. They have 20%. They have a 20% tax credit. Remember, it's layered. It's 20, 25, 30, or it's 40 if you use the MTC Plus. This one is a 20. So 20% of $7,946 is $1,589. So 1589 on the itemized deductions comes directly off the mortgage interest, which sounds a little counterintuitive to me as just a layperson, but you'll see how it works in the end. So the mortgage interest gets deducted by the amount of the credit. So here's where we see the difference. The person with the mortgage tax credit or the mortgage credit certificate has itemized deductions of $97.72, whereas the person who does not has itemized deductions of $11,361. So let's go back to that tax return. And as you come down and you take all their exemptions and all that and their taxable income, you see that the person with the mortgage tax credit has a little bit higher. They have a little bit higher taxable income because of the reduction in the itemized deductions. So they owe $5,010 in taxes, as opposed to the person who without the tax credit is at $47.78. However, since it is a direct deduction, that $1589 is a direct deduction, that amount comes directly off of their taxable income, or their tax liability. I shouldn't say their taxable income, their tax liability. And it lowers their tax liability to $34.21 as opposed to $47.78 for the person without the credit. Now, these credits are proprietary, so there are, the borrower may have other credits. Maybe they can take credit for child care and dependent care expenses. So if the borrower cannot take the full amount of the tax credit, they can carry it forward for 3 years. So maybe they can only, by the time it's all said and done, they can only use $1,000, because you can't owe negative tax liability. Get it down to zero, but you can't go negative. So if they do have anything left over because they have other credits, then they can carry it forward for 3 years. The other thing the IRS limits is the maximum dollar amount. Unless they're getting the 20% credit, the maximum dollar amount is $2,000. So it can be 40% up to $2,000, 25, 30, or 40% up to $2,000, and for whatever reason, they don't limit the 20%. I don't know what their reasoning is for that, but we don't know why the IRS does a lot of this. So when it comes down to the bottom line, this borrower is getting, they paid $57.30 in taxes throughout the year. So this borrower is going to get a $2,309 refund, as opposed to the borrower without a tax credit is going to get $952. So you can see that it pays for itself. For a lot of borrowers, it's going to pay for itself in year 1. The mortgage tax credit is good for the life of that loan. So as long as that borrower is paying interest, mortgage interest, they're going to be able to take this mortgage tax credit, regardless of whether their income increases or anything like that. If they refinance out of that loan, they have 1 year to come to us and ask us to reissue that credit, and we will reissue it based on the original loan terms and loan amount and all that. But again, even if they refinance that mortgage, they can use this tax credit if they come to us and ask us to reissue it. They can use it as long as they are paying interest, and it's their primary residence. It does have to be their primary residence. If it's their primary residence and they're paying interest on it, they can use this tax credit. So it truly is a great product for a first-time home buyer, and I didn't understand it. When I was using OHFA's products, I didn't understand how it worked. I didn't get it. It made no sense to me. It seemed really complicated. So I didn't use it, and we didn't offer it as a lender because we didn't understand it. But it's seriously that easy and that basic, and it's no more work for you to do than just reserving a loan with us and providing us the documentation. There are some extra costs, which we'll get into here in a minute, but there's really nothing more to it than that. And hopefully you can see that you, okay, somebody said you can't hear me and that I cut out. Can anybody hear me? Okay. You guys hear? Okay. Okay. So hopefully you can okay. All right. So hopefully that explains it. Again, if you have questions, ask, and I'll get to those at the end. But it's really a great product for a first-time home buyer, and it's very simple. Okay, we also offer home rehab, repair, and weatherization. I don't know if you guys do these or not, but just to let you know that we do. We offer the limited FHA 203K loans for certain repairs, up to $35,000. I've referenced the HUD Mortgagee Letter 2005-50. All of these mortgagee letters may have been updated with the 4,000 that came out last September. I don't have the new chapters or sections referenced in here, but nothing has changed on those programs other than FHA changed it from a streamlined to a limited, but everything works the same. So if you can find these mortgagee letters or these reference, where I referenced it, you're going to find the program. We offer the 203B with repairs up to $5,000, and I've referenced the section in the chapter where you can find that and what can be done on that. And then the weatherization program up to $2,000 to assist in reducing heating and cooling. So we do allow that. Okay, loan requirements, borrower qualification. We just ask you to follow our term sheets. Our term sheets are available on our website, and they're available on Lender Online. Eligible properties, 1 to 4 unit properties, condos, PUDs. Please refer to the term sheet for specific product guidelines. We no longer do manufactured homes, effective on 12/1/15. Our income and purchase price limits, find those on Lender Online. You can find them on our website. They are, as I said before, they are broken down by county and how many people live in the home. And I think you'll find that our income price limits are pretty generous, and our purchase price limits are pretty generous for a first-time home buyer. But keeping in mind that if you're using the mortgage tax credit program, they're a little bit lower, and those are out there also. The down payment assistance is a true second mortgage. Excuse me. It's a true second mortgage. We do file a lien. And home buyer education is required on all of our products except for the MTC Basic, which again is your own first mortgage, and you're just adding the MTC Basic on top of that. We do have credit score and DTI requirements. For a conventional VA and USDA loan, the credit score is 640, minimum is 640. If it's 640 to 659, the max DTI is 45%. Also, if the LTV exceeds 95, the max DTI is also 45 on the conventional, for a conventional loan. If it's 660 higher on those 3 products, then you can go to 50% DTI. FHA is a 660 credit score and a 45% DTI. So you have to have a minimum of 660 and on the credit score and a max DTI of 45. Okay, borrower documentation, our income calculations. One of the changes that we made last year that has been a huge hit is we no longer look at household income. So if you had a borrower and a non-borrowing spouse, or a borrower and their 21-year-old still lives in the home, anyone over 18 will require that we looked at everybody's income, the whole household. Well, we determined that we really don't need to do that. The IRS doesn't require it, and it was one of those things that we were doing because we've always done it. So we're only looking at the income for the borrower, for anybody who's going to live in the home and who's going to be obligated on the note. So if you have a husband and a wife, and maybe together their income exceeds our income limits, but separately they each qualify, and they can qualify, one or the other can qualify for your mortgage without the other one on there, and they qualify with our income, that's all we're going to look at, is whoever is living in the home and obligated on the note. So non-purchasing spouses don't count, kids who live in the home don't count, a non-occupant co-borrower, none of that counts, just the borrower who is living in the home and obligated on the note. Now, having said that, we're going to look at more things possibly than you look at, because maybe, you know, as in order to qualify for the loan, that borrower gets child support, and you don't care. They don't need it to qualify. That's just, you know, a compensating factor. But for us, it goes towards what their eligibility income, because we're looking at what's the max, what's our max income limit, and does that borrower fall within that category. If they exceed it, then they can't use our program. So again, we are going to be looking at income differently than you are, but we're not going to be looking at anything other than the borrower who is on that loan. We do require that we have 3 years federal income tax returns for all borrowers. We're looking for additional income that we need to consider. We're also looking to see if they've owned a home in the last 3 years where they've taken. We do ask for current pay stubs, at least 2 within the last 60 days, or 1 pay stub and a written VOE. If they're using the Grant to Grad program, we want a copy of the degree to show, you know, what their graduation, what their degree level is, and when they graduated, that it's within that 8 months. And the heroes, again, we refer you to the term sheets because all those different occupations have requirements. Okay, so I did talk about that every loan we have, all of our loans except for the MTC basic require home buyer education. We've tried to make it as simple as possible. So once you reserve that loan in our system, you could just direct your borrower, and only one borrower on the loan has to do counseling. So if you could just direct your borrower to our website, there is on the home page at the bottom, there's an icon that says Home Buyer Counseling. One of the borrowers has to log in there with their last name and their Social Security number. They will take a test and a budget, which they will, it will upload to our system to Lender Online. So we see it, we'll have access to it. At the end of the test budget, they have the option of choosing between 5 home counselors, all HUD-approved counseling agents. And they'll choose one of the counselors. An email will be sent to that counselor. They have 48 hours to contact that borrower to set up a 1-hour phone session. We monitor that every day, so we make sure that those are moving through and that the borrower's doing the counseling. So you don't have to do anything. If you can just get them there, the website will take it from there. They do need to go in and register. And do the test in the budget, but we'll take it from there. We will contact them if they haven't done it. And if for some reason they just are not cooperating, we will contact you and let you know, because that's obviously going to hold up an approval on our end if they don't do the home buyer counseling. We typically have them within 5 to 7 days of application, and most of the time we have them before we receive the package. But we try to make it as easy as possible for you. But that's all you really need to do is get them there. Get them to the website. Once you reserve the loan, they can't take it prior to reservation, but once you reserved it, get them there, and we'll make sure they get the education. Okay, so fees. Everybody wants to know how much it costs, and it's a good question. Our fees are for the first-time home buyer and the next home loans. There is we allow a 0.5% origination fee to be charged, and that is part of the compensation that comes. That's your fee. That's payable to you. We don't allow you to do more than a 0.5%. We allow up to 0.5%. So if you don't charge it, that's just compensation you don't get. So up to you, but you can charge a 0.5% origination. There's a $400 funding fee and an $85 tax service fee payable to U.S. Bank, and a $100 admin fee payable to OHFA. Same thing for the MTC Plus loans, with the exception of there is an additional $250 loan fee payable to OHFA. We also do allow you as a lender to charge an additional $250 to the borrower if you want to. Some do, some don't, but if you charge that, we want it broken down. We do not want it showing on the CD as $500 payable to OHFA. You need to break it down so it shows $250 to us and $250 to you, because we're not collecting $500 from the borrower. And then the MTC basic fee it's just $500. If you're not doing, you know, our first, second, then it's just $500 fee. And as you can see from the example before, that the borrower is going to definitely make that back. If any of the fees are going to make back on the end state. All of these fees are, if you choose not to charge them, we strongly encourage that you don't do that, that you do charge them, because they're going to be paid anyway. U.S. Bank is going to take their fees when they purchase the loan, and we're not going to approve the loan for purchase until we get ours. So, you know, one way or another, the money we're getting, the money's going to be there. So I recommend that you disclose that to the borrower. It's a good benefit. So basically what happens after registration is you're going to process the loan, you're going to submit the commitment package to us, you're going to wait for us to approve it. Please wait for us to approve the commitment before you close that loan. You will have once we approve it, you know, there'll be a commitment letter out there for you, and you can close whenever you want to. You'll close, you advance the funds for the first and the second. After closing, you submit what we call a purchase package to us to review, and you're going to send the file to U.S. Bank. U.S. Bank will not purchase the loan without having our approval. And then once purchased, those approvals are through, U.S. Bank will purchase the loan, fund you all the money back for the first and the second, and that's pretty much it. That's a pretty basic process. So, in regards to the pipeline, we do ask that you register loans that you think are going to close. Obviously, nobody wants a pipeline full of things that aren't going to close, but that doesn't happen, so we're not really concerned about that. We do ask to keep it clean and current. We will be in touch with you if we have what we call an 18 and a 45-day report. So if we haven't by day 18 received that commitment package from you, we're going to reach out to you and say, this is a reminder, hey, we'd like it by day 25. We need to hear back from you, let us know what's going on, and we will reach out to you to get that package. If we don't receive it by a certain date, which will be in the email, and we don't hear anything from you, we are going to assume that that loan needs to be canceled, and we're going to cancel that reservation. So please respond to us and let us know what's going on. Same thing for what we call our 45-day report, because you're getting close to that 70 days. We're just going to send you an email, kind of remind you that, hey, you know, you got 70 days. Just kind of as a courtesy. So if at any time that we reach out to you and you realize that you haven't canceled something that we need to cancel, just let us know and we'll do that for you. And we will always reach out to you before we cancel a reservation. So you're always going to have the opportunity to let us know that it's still going and it's still active. So once a loan is reserved, what can change? Without prior approval, we can correct anything on. Once you've reserved it, you can't correct anything at this point. We have heard we're supposed to be getting an updated version of Lender Online. We're supposed to have that first quarter, so I'm not sure when that's coming. But we've heard that there are things that you're going to be able to correct on it when we do get that, but for right now, you can't really correct anything. So if you make a mistake, you can either email us and we can correct it for you, or when you submit the docs to us, just submit the corrections then and we'll get them corrected. What can't change without prior approval is you can't change their rate without prior approval from us. You can't change the product without prior approval. And you can't cancel and re-reserve the borrower at a lower rate. So believe me, it happens every day that somebody decides maybe they reserved it at 2.5% and now they want 5%, or I meant to do this program and I did this instead, or I really meant to add MTC and the borrower wants it, so can you do that? Just send us an email and I'll give you, there'll be an address at the end of this presentation, an email address where you can send for any of those changes. And I think we're pretty easy going, so we'll do whatever we can do for you. Any changes in loan product or pricing or something like that will be worst case. So we'll look at the day you reserved it and the current day's rates, and whichever one's the worst is what you're going to get. Okay. Once the reservation is made, the loan is committed to the borrower, so you may not take advantage of subsequent lower rates unless you wait the required 60 days from the original 70. If you have any questions regarding the borrower or property eligibility, you can direct them to either your OHFA rep or U.S. Bank, or really any of us. I mean, any of us can answer any questions. Change of rate, type, that kind of thing can go to our mortgage funding department. And I'll give you all that information in a second. Just wanted to also point out that we have an awesome marketing department. There are marketing materials online, on Lender Online, and also on our website that are, if you wanted to use any of these sheets to send out, you can fill them in with your contact info. You can contact me, and I can put you in contact with our marketing department if you wanted to co-brand and you wanted to add your own logo to these flyers. They will do that for you at no cost. And they just do a really nice job. They put out a really good flyer. This is our staff directory, and again, I will send this out to everybody with a couple other little attachments. Everybody who's on the webinar. This is our staff. One person I want to point out is John Dewey, who's our real estate relations manager for any of you loan officers who are out there. He offers free CE courses. He will come to you if you want to, they say buy the donuts and they'll come for realtors. If you wanted to set something up where you had the realtors come in, he will do, I think he does a fair lending, a fair housing, and I think he does a course on OHFA's products. He gets pretty booked pretty fast, but if you wanted to, and he does a great job. He really does a very good job in his presentations. He makes it interactive. He makes it fun. But here's his contact information on here if you want to contact him about setting up one of those CE classes. And then who to call with questions. You can call for compliance or down payment assistance questions. You can call your OHFA rep for loan purchasing or underwriting questions. You can contact U.S. Bank. And any changes in loan reservations, you can contact Ashley Young, who is in our mortgage funding department. And that is it for the presentation. I'm going to come over and look and see what kind of questions we have. Excuse me, make sure I can get all of these. What extra items does a servicer have to do to give MTC basic credit? What extra items does a servicer have to do to give MTC basic credit? I don't really know the answer to that. I've heard, since we obviously don't get involved in that part, I have heard that there are, I think that the servicer might have to file a report with the IRS. I know that we have to, we send out to the lender, whoever does the MTC, we send out a some kind of report that they have to, obviously I don't do it, some kind of report that has to be filed with them on an annual basis. So I know some servicers, I've heard from lenders that some servicers don't like to do that because they think the reporting is kind of cumbersome, although I believe we pretty much do it and send it to you to send to the IRS. But I don't really know the answer to that question. I can find that out for you, Lisa, and let you know. If you have approved eligible findings that exceed the max DTI for the program, can the loan move forward? That is a great question, but no, just because you have an approved eligible at a higher DTI than our max does not mean you can do that. You have to stick to our max DTI limits. How do I get an invite to the ops training and call for tomorrow in the U.S. Bank? You know what? I'll send out, that's from Todd Ireland. I will send out with the presentation from today, I will send out to all of you the memo that shows the links for the training for the next tomorrow and Friday, and that way if you want to sign up or you got anybody that you want to get signed up on it, you can do that, and that way everybody's just got it. Okay, here's a question. Can a customer pay 20% down and avoid PMI? Where do I find info on this? Yes, absolutely. The borrower can put 20% down and not have to pay PMI. And all that information is on our term sheet. So if you go to our website, it's ohiohome.org. You'll see a menu button that says Our Partners, and when you click on that, it'll have a there'll be something that says, what does it say? I should probably look. I should know this because I look at it every day. It says Our Partners and then Lenders. I'm sorry. It says Our Partners and then it says Lenders. And if you scroll to the bottom of that page, the lender page, it has term sheets are on there. So they're all on there. You can find our conventional term sheets on there. Okay, let me see if anybody else has any questions. I think I have answered everything that everyone has. Hold on one second. Okay, I'm going to, let me see if I can. Don Gallo, are you there?
I'm here.
Hello, how are you?
I'm doing very well. How are you?
Good. Did you have a question that I did not answer?
No, I was trying to respond to you that yes, we could hear you, but I hit the thumbs up button instead.
Okay.
My apologies. Yeah.
Oh, that's fine. It's kind of hard. I have to see that there's a question and there's a lot of responses over here. So
understood. You did a great job. Thank you so much for your help today.
Sure, thanks. Okay. Let me see. Okay, I think I caught everybody's questions, but if you have any, please feel free to shoot me an email. I will, again, this will be recorded, so I think it has to go, somebody has to transfer it to YouTube, and then they can put it out there on the website, so it'll probably be out there within the week. And again, I will send all of you an email with this presentation and a couple other little documents that I think you'll find useful. So if you have questions after that, please feel free to contact me. I'm here most of the time. So again, thank you for your time. Really appreciate it. Really appreciate the business that we're getting from you guys, and we are doing everything we can to do what we can for you to make sure that you get those closings done. So thank you very much. If you need anything, give me a call. Have a good day.